Well, good morning, everybody. Thank you for coming out this morning to learn a couple tax tips with Sarah and I. We both work at Fenner, Melstrom, and Dooling. As mentioned, it's a CPA firm in Birmingham. We focus pretty much solely on closely held businesses, entrepreneurial clients, so people who own their own businesses. We don't really do anything for nonprofits. So we love helping our entrepreneur clients find good tax breaks and develop their businesses so that they can achieve their dreams. That's kind of that's what does it for me. So we're excited to share some stuff with you today. We're going to try to keep our presentation pretty high level this morning, being that we have half an hour and we could dive into the tax code for days, right? So we're hoping the idea is that you walk out of here this morning with a couple buzzwords and main concepts in your mind so that you know, oh, this might apply to me. Maybe I need to follow up with someone. Maybe, and of course, if you have questions after today or at the end, we're going to have some time, and we're glad to assist you with that as well. So, I'm Stephanie McPherson.
Sarah.
And Sarah's going to go ahead and start us off with some of the changes to the individual side. As you all know, with the Tax Cuts and Jobs Act, maybe you don't, but there was a huge overhaul in taxes and tax legislature in 2017. Pretty much all the new changes came about with processing the returns last year, for 2018 being the first year that we are seeing significantly different tax forms. Things are being calculated very differently. So this is kind of year two of some dramatic changes. So some of these things probably aren't brand new to you. You probably heard some of the buzz that's been going on. You probably have seen some differences in your tax returns. Or maybe you're like some of our clients and you don't even look at your tax return. When we send it to you, you're just like, great, it's done. It goes in the drawer, and like you just trust your CPA to handle that, which is great too. So, all right, Sarah.
Hey everyone, I'm Sarah. Hopefully everybody got a tax planning guide. And we do have two handouts on the table. One is today's agenda. The other one is for 1099 contracts. That Stephanie will go through later. And we do have some tax pocket guides on the table if you'd like to grab one. So I got started with individual portion. I know we're tight on time today, so I'm going to be keep everything really high level and probably going really fast. And so let's talk about tax. I hope this is on your New Year resolution. So the first thing is the tax rate and the bracket. If you turn to the last page of this tax planning guide, and you will see there's 2019 individual income tax rate schedules, and you will see there are 7 tax rates and tax bracket there. The only thing I want to point out is with the new tax law changes, the top rate is now 37%. It used to be 39.6%. So you will see there's a reduced rate there. And moving on to the second one, we have standard deduction and itemized deduction. So if you like to turn your planning guide to page 2, and there's a chart 1 here showing you the 2019 standard deduction. I'm going to take joint filers as example here as 24,400. So before the new tax law, it was about, in 2017, it was about 12,700. They almost doubled it in 2018, and they got rid of the personal exemption, which was 4,000. So now the standard deduction increased. A lot of people will be using standard deduction other than the itemized deduction. So if all your itemized deduction add all those up over the standard deduction, then you can use itemized deduction. So what are the items included on the itemized deduction? That's your 1040 Schedule A. It includes medical expense, state and local taxes, mortgage interest expense, and charitable contributions. So let's talk over those changes. Medical expense. If you like to turn over to page 3, here's this article here. It says it may be harder to deduct your medical expense this year, things in 2019. So in 2018, there was a floor set at 7.5%. Now for 2019, they increased increase that to 10%, meaning that if you have to pay at least 10% of your AGI, the excess amount of that you can deduct on the Schedule A. If your expenses are lower than that, then you basically pay it out of your pocket and you don't get any tax benefit. And then the second item on there is the state and local taxes. That includes the state income tax, city income tax, and your personal property taxes, like your car registration fees and your primary and secondary residence taxes, property taxes. So a lot of it used to be unlimited due to the new tax law changes. They capped at 10,000. So a lot of people just lost that deduction over there. That's why a lot of people might not be able to file the Schedule A deduction because that's going to lower their total deduction.
May I interject really quick? So for a lot of our clients, that was a huge, significant change because we're like in Birmingham, right? The property taxes are like through the roof. So people who are deducting like $30,000, $20,000 of state and local taxes along with their residential taxes, that's now capped at 10 grand. So that, along with the standard deduction now being so high, a lot of people, it's not worth itemizing anymore. So people who might have always itemized in the past aren't anymore. And the AGI is your adjusted gross income. So for the medical expenses, the 10% threshold means you have to say your adjusted gross income on your return is $100,000. You have to spend $10,000 on medical expenses before $1 counts towards your itemized total. And that itemized total has to be over the standard. So not many people are itemizing anymore.
Thanks for clear that up. And the next item we have mortgage interest deduction. So this is on your tax planning guide, page 2, down the bottom. There's a house picture there. So the change was they decreased the mortgage debt from $1 million to $750,000 on your debt, meaning that if your debt is over $750,000, then there's a calculation on how much you can take as a deduction as your mortgage interest expense. And they also got rid of the home equity debt interest deduction that you used to pay interest on your credit card loans where your interest spent by car, so you are no longer you can no longer deduct that interest. And the last item I want to talk about is the charitable contribution. So, like I said, there are a lot of people who just cannot do the itemized deduction. So there is no tax benefit for people who cannot do that. So the tip here is if you are really close to the standard deduction number, then you can bunch up the charitable contribution. You can contribute by year end to cover 2 years. So you can use that charitable contribution rather than if you do 1 year each time, you're not going to be able to take any tax benefit there.
I'm going to interject again if it's okay. So some of our clients too, with your brokerage firms, Merrill Lynch, Fidelity, they're offering, if you're already a person who's very charitable and you already know you're going to give $10,000 to your church this year and next year or whatever the nonprofit might be, you are able to begin a fund where you can designate all your contributions. You can put them all in 1 year to the fund. You can fund $100,000 if you know you're going to give that over the next 3 years. You can deduct that whole $100,000 and take your itemized deductions the year that you fund it, and then they'll actually give the funds to the profit as you allocate those over the years. So you don't have to give $100,000 right to the nonprofit right now, but you can put it all in the fund and take the deduction right now. So that's something that's out there. Talk with your brokerage firm if that interests you, but a lot of our clients are kind of heading towards that as well.
Next one is tax credits. So this is on the tax planning guide, page 4. The first column there, child dependent and adoption credits under there. So the change was the child tax credit is now $2,000 per child. It used to be $1,000, so they doubled that. But of course, a portion of it is refundable credits, meaning that if you don't have, even if you don't have tax liability, you can still get those money back. But if you look at this chart 2 next to it, there are different tax thresholds. Basic meaning that if your income is over a certain threshold, you may not get 100% of that 2,000. You may get a portion of it, and once your income is reached, for example, the married file jointly 440,000, that you probably get zero. And one thing I'm gonna note here is that on the top says AGI, that's modified adjust gross income, so that's something different than the AGI, and that involves a more complicated calculation. So it's not just taking one number from your return and you're able to get an answer. The next 2 credits I want to talk about is the page 5, the education credits. 2 things really quick I want to point out here. The really popular one is the American Opportunity credits. That applies to the post-secondary education for the first 4 years. So it's 2,000. It's the first 100% of the first 2,000 tuition and the related expense, and then the 25% of the next 2,000 expense. So the maximum is 2,500 per student, and of course it phase out as your income is getting higher, and that you can refer to the chart 2 as to see that limitation. And if you use all up your American Opportunity tax credit for the first 2 years, you can use the lifetime learning credit. So that is up to the 2,000 per tax return. So it's not per student, it's per tax return. And that's up to the $10,000 expense. So it's not if you pay 2,000, you get 2,000 back. It's if you pay 2,000, you get 20%. So that's 400, and the maximum is 2,000. The next item we have here is the investment. So that's on your planning guide, page 6 and 7. So I guess first I'm going to define what investment income is. If you go to a financial institution, that you can open an account at, say, Fidelity, and you can put your money in there, and you can buy stocks, buy bonds, or trading securities. So any gain and loss here is basically capital gain and loss, and that's your investment income. So what we want to talk about here is to take advantage of the long-term capital gain, meaning that anything you held over 12 months, that's going to be considered long-term, and it depends on your taxable income threshold. The long-term capital gain rate is ranged from 0%, 15%, and 20%. So that depends on your taxable income. I guess this is really complicated area, and usually we do those projections before year end, so you will know that what's the gain or loss in your accounts, and you can consult your tax advisor or your CPA on how you can take advantage of that rate. And another thing related to this is the net investment income tax, the 3.8%. That's on your page 7, the right column there. It basically stating that if you're in the higher income tax bracket, in the eyes of IRS, they're going to assess additional 3.8% on your investment income. But of course, the calculation is more complicated than that. It's not taking your investment income times the 3.8%. There's a lot of calculation involved in there too. So I guess the bottom line here is if you do have investment account, you should definitely consult with your tax advisor and try to take advantage of that. And the last item I have is the HSA, FSA, and 529 plans. So this is back to page 3. So HSA is health savings account. If you are covered by a qualified high deductible health plan, and your employee will sponsor that HSA, so you can put away in 2000. Well, this was 2019. Remember, I believe is 3,500 for yourself only, or 7,000 for the family. And you will see there, if you are 55 years old or older, you can get additional 1,000. So this is a pre-tax money you can use to pay for qualified health insurance. And the money is, once you put it in an account, it could grow because it's an investment. So that income is tax-free. And you can also carry that from year to year. And along with that is the FSA, it's a flexible spending account. So the same thing, you can put that pre-tax, but I believe it has to be employer sponsored, and not to exceed 2,700 in 2019. And you can also pay that with qualified medical expense, and if you don't use that by year end, you can roll over up to 500 to next year, or sometimes give you a grace period for 2.5 months in the next year, so you can use those. So I think that's all I have for individual. I'm going to turn this over to Stephanie for a business part.
Okay, let me grab my cheat sheet here. All right, so I thought of a couple things too. Sorry, I'm kind of all over the place, but I wanna just point out a couple things, big takeaways from the individual side before I forget and they go into the abyss. But one of the biggest changes, as Sarah mentioned, is that personal exemptions have gone away. So we all know about dependents, right? We all want to claim our dependents, our kids. If you're taking care of an elderly parent, you can sometimes claim them as a dependent. That used to be a lot more advantageous before the Tax Cuts and Jobs Act. But now you really are only getting the benefit for a dependent if they're a child under 17, because you're able to take that child tax credit. If some of you women in this room might have kids who are college age, if you have kids in school, if you're really high income and you're not able to get some of those education credits that Sarah was mentioning, might be better to have your student file their own tax return and get those education credits, because it's no benefit to you to claim them as a dependent if they're not a child under 17. So there are some tax planning considerations to be made there. And then someone mentioned buying and selling a home in here. I can't remember. Okay. So I just want to touch on that for you. If it's a principal residence that you've lived in, not like a vacation home or something that you've lived in for however many years, and you're selling it and it's the first transaction, I think you could get one of those. Help me out. It's been a minute since I've had a client in this situation, but I think you can take that every 10 or 5 years. So unless you've sold another home recently, then you can take that exemption, and it would basically mean that if there's a gain up to, again, I think it's like 250,000.
500 for filing jointly.
Yes, if you're filing jointly, it's 500,000. If you're single, it's 250,000. That's the gain portion. Your gain on the sale, you don't have to pick that up at all if it's your principal residence. So if you have more questions, I'm happy to help you with it after, or consult your tax advisor. But I wanted to touch on that. Okay, so moving right along into businesses. Just a couple of important year-end reminders, because we're at that time right now. Right now, you are all probably expecting your W-2s, if that's applicable to you, or you're expecting 1099s. Does anybody not know what I'm talking about when I say 1099s? Or is everyone kind of, okay. Hopefully, I know we have a lot of entrepreneurs and self-employed in this room who are probably looking to receive a couple of those this year. Those should be coming to you by January 31st, as well as your W-2s. 1099s. If you are a business owner, you are required by law to issue a 1099 to anyone who performs services to you who's not an employee, who is not incorporated, meaning either an S corp or a C corporation. So any other partnership or a single member LLC, business, or individual who is doing lawn cutting or consulting, whatever it might be, you're required to issue them a 1099. If you don't, and the IRS finds out, they could basically disallow your deduction. So if I own a business and I hire a guy to cut my lawn and I'm taking that deduction for what I paid him, but I'm not issuing him a 1099, and the IRS comes in and audits you, they could just disallow that. So just a reminder to throw out there to everybody. There's a sheet on 1099s that we gave you guys that basically outlines the different payments you want to look into when you're considering whether or not you need to issue someone one or whether or not you should be expecting one. That's just meant to be a general guide. There's a little blurb on what our clients need to get to us if they want us to prepare. That's just for our clients. You can ignore it, but I thought that might be handy. Okay, so with the Tax Cuts and Jobs Act, we saw significant changes to the tax rates for businesses as well. Mainly C corporations. C corporations used to be much like our individual tax rates, graduated, meaning that at different income amounts, you were at different tax rates. Now it is a flat 21% tax rate for all C corporations, regardless of where the income is at. So that's pretty awesome for all the big C corps out there who might have had a lot of income. On the other hand, if you're a C corp that wasn't making a ton of money and you were getting a nicer tax rate because you were at a lower income rate, you maybe got bumped up to the 21. But for the most part, that has been a big tax break for C corporations. However, that doesn't apply to partnerships or S corporations. I heard a lot of people this morning saying that they are an S corporation. As you probably know, I hope you do, or you will now after today, you are taxed on your S corp or partnership income at your individual level. Meaning you do file a tax return for the partnership or S corporation. Another thing I hope you knew, but maybe you're walking out today going, oh, I need to get on that. But there is a tax return, but you don't pay the tax with that tax return. The tax that's due, the income flows through to your personal return as flow-through income. Those are called flow-through entities because the tax goes to your individual return. With flow-through entities, we also saw that the IRS, they're like, okay, we're giving this great tax break to the C corporations, giving them this 20% tax rate. We got to do something for the little guys, the flow-throughs. So what they thought of was the Section 199A, or you guys might have heard this buzzword going around, the QBID deduction, or qualified business income deduction for flow-through entities. What that is at the highest level, without thresholds and all that, it's a 20% deduction on all your business income. So meaning if you have a partnership and you make $200,000 and that you're the only, I guess you wouldn't be the only owner in a partnership. Say Sarah and I are a partnership, we make $100,000. 50,000 she's going to pick up on her individual return because she's a 50% partner, 50% I'm going to pick up on my individual return. Both of us are allowed to take a 20% deduction on that 50 grand at our individual level, which is great. However, with tax simplification, right, which was the intent, it actually has been tremendously difficult for us in the CPA world because there are lots of thresholds and rules. So if you're in a position where you might be considering that, you probably should consult with a tax advisor. But I want to give you kind of the basics. If you're above a certain income threshold at your total individual level, meaning your adjusted gross income, that includes not just your business income, but everything on your W-2, everything else on your return, you could not be eligible to take the entire 20% deduction. Also, if you're at the higher end of that, I think it's about 400,000, 415 for married filing joint, where it's completely wiped out. That's the high end of the threshold. It starts phasing out at about 200,000. And then for individual, it's about 100, and then 200,000 where it's completely gone. That's your income. So the other thing to consider is if you're in that range, there's a couple rules. One, you might be able to take some of the deduction, but it's limited to 50% of the wages you pay out from your business, meaning if you're really high income and you don't pay any wages, you don't get to take any deduction. So for us with tax planning, we're telling all of our S corporations that are high income individuals, hey, make sure you're paying out enough wages that you can take that Cupid deduction. So you're capped at 50% of the W-2 wages, or 25% of your wages, and then 2.5% of your tangible property. It is, guys, I don't want to go too far into this, but the point being, you get a 20% deduction if you're a flow through, but beware, especially if you're high income. I guess that's what I want you to leave with. Depreciation. So generally when you purchase, it's a lot. Generally when you purchase what we call an asset for your business, a computer, or something that's like longer than 1 year. So not office supplies, not your general just routine business expenses, but something that's going to last the business and be of service for multiple years, anytime longer than 1. Generally what you are required to do is to capitalize and depreciate that, or break out the expense over the number of years that you're expected to have that item in use. So it's tricky. I don't want to dive too deep into depreciation, but I do want you to know that for tax purposes, you can take accelerated depreciation for the most part on a lot of these items: computers, equipment, vehicles. So although for your books, when you're just doing your balance sheet and your P&L for your business, you might take that deduction over what we call the straight line method. If I have a computer, I think it's going to last me 10 years. I'll expense a portion of that evenly over 10 years until it's all depreciated off and expensed. But for tax purposes, the IRS allows you to take either a 179 expense deduction, or we also now have bonus depreciation, which both can get you up to 100% of a deduction in the year you buy it for tax purposes. Meaning there's a difference between the depreciation you report on your books and what you take on your tax return. So especially those of you who have your own businesses who maybe don't consult with your CPA, or you're doing it on your own, that's definitely something that you want to be cognizant of, and just be aware that those are out there. Vehicles are a huge one, and there are different thresholds depending on the weight of the vehicle. So if you're using the vehicle has to be used more than 50% in your business for you to even think about taking 179 bonus. If it's used more than 50% in your business, then you are eligible to take those deductions. Vehicles are a little different. If the vehicle is between 6,000 pounds and 14,000 pounds, you can take $25,000 of Section 179 depreciation the first year that you buy it. So if it's year end and you're like, gosh, I really need a new car, I got a business, can I deduct it? Likely, if it's that's like SUVs, that's most larger vehicles, you can take $25,000 for tax. If the vehicle is under 6,000 pounds, that is a luxury auto or a passenger automobile, and the rules are a little more stringent. You can take $18,000 max. $10,000 is bonus depreciation, and then $8,000 of regular depreciation. So it's tricky. You got to kind of know your buzzwords so that when you leave today, you know what kind of situation you're in. If your vehicle is over 14,000 pounds, this is like if you own a manufacturing company and you have giant supply trucks or something, you can take all of the deduction for tax purposes. You can expense all of it as 179 deduction. So just beware. Most people fall into the range where they can take a pretty nice $25,000 deduction, and then they can take the rest over the remaining years. That's kind of how that usually works. I want to touch just briefly on some just self-employment considerations. A lot of us here are small business owners, especially single-member LLCs or S corporations where you're the only owner, and there are some things to consider there for sure. One being that if you're not a great reason, I'm glad so many women this morning were like, be an S corporation, it's awesome, because it is, if you're a Schedule C, meaning that you own your own business and you're just filing it as a one form along with your 1040, and you don't have it separated into a separate legal entity yet with its own EIN and all that. One, there's an extra layer of protection that comes with turning your business into an S corp or partnership, meaning that if you were to get sued, God forbid, by someone, they can't go after all of your assets, everything that you own personally. It's limited to what the business has. So it's really good for protection. And it's also, with 1099s these days, you got to be really careful with your information that's out there. And if you're not set up as an S corp or a partnership and having them send your 1099s to that business, it's not a big deal, but your social security is on all those 1099s. It's better and more safe to just be set up that way. The other really big benefit with setting up an S corporation or a partnership rather than just filing as a Schedule C is that if you're a Schedule C, you're paying self-employment taxes on your income. And that means your and the employer's portion of your Social Security and your Medicare up to 7.65%. So you're paying extra tax, self-employment tax, when you could make that an S corporation or a partnership. Now, it gets tricky. Partnerships, you're not required to pay wages. S corporations, if you're the owner, you're required to pay yourself a reasonable compensation. Meaning, if I would hire someone to do the same work I'm doing running my business, and I would have to pay that person $500,000 a year, and I'm paying myself $5, or if I'm paying myself $2 million, the IRS might say, "Hey, you're trying to work around. You're trying to not pay all your payroll taxes, or you're taking a little more of a wage than you should be." So you don't really necessarily, S corporations avoid paying payroll taxes, but you don't have to pay that self-employment tax. So that just briefly to touch on if you're thinking about entity structure. Another thing I want to talk about briefly is, I know Brenda mentioned we would touch on people in transition. There's not, the one big thing I would say for anyone in transition between jobs is you have to think about your withholdings or what you're paying in for your taxes throughout the year. The IRS basically says that you are required to pay their safe harbor limits to be safe from underpayment penalty at the end of the year, where the IRS can't slam you with a penalty for paying less than you were supposed to in withholdings or estimated taxes. For most people, you have to pay either 90% of the current year's tax or 100% of the prior year's tax. So if I owed 10 grand federal last year, I better have 10 grand paid in by the time I file my tax return in April of the next year, or I have to pay 90% of what I currently owe. Don't always know what you're going to currently owe, so sometimes it's best to plan to just pay in what you had before. Now, for most people, if you're just receiving a W-2 from your employer, you're paying in what you need to pay in because they're taking that right out of your paycheck via that W-4 that you fill out at the beginning of the year, where you claim how many exemptions that you have and how much you want taken out. Also, another thing that people might have noticed is they had a little more money in their pocket the last couple of years. They've changed the withholding rates. So some people, we had some clients that were saying, I owe tax at the end of the year, and I don't know why. I've never had to pay tax. I have money taken out of my paycheck. Well, most of the population didn't know that the IRS changed the withholding charts. So when you used to have enough withheld from your paycheck to pay your tax, now they're like, oh, well, this is crazy. I thought we were getting tax breaks, and I thought we were going to pay less tax. But what they don't realize is you are paying less tax in total. You've had more money in your pocket all year. So you've enjoyed some more money to take home on each paycheck. Now you got to pay the piper at the end of the year. So if you're unaware where you're at with that, maybe consider revisiting your W-4. You can file a new one anytime. Talk with your employer about if you need to adjust that, especially after you see where you come at the end of this year, whether you owe or don't. You can make changes there. But if you're not receiving a W-2 and you're strictly, if you own your own business and you're paying the tax on your income, on pretty much just the business, that's your income, you are still required to pay tax throughout the year. You're just not doing it via withholding from your paycheck. So what you would then do is make estimated payments. Does anybody in here make estimated payments, if you don't mind me asking? Okay, so we're familiar enough. And you're basically, for the most case for us and with our clients, we're just having them pay enough in estimated payments to safe harbor them from those penalties of and interest associated with underpayment. But that doesn't mean that they might still not owe at the end of the year. And some of our clients say, I want you to project what I'm going to owe and I'll pay it all now. I'd rather not pay in April. And some of our clients are like, I'll hold on to my money as long as I can. I'm not going to give a dime to the government that I don't have to give them until April. So, everybody's situation is different. But beware, if you're not if you own a business and you don't have a W-2 and you're not making estimated payments, consider it maybe. You don't want to get slammed with an underpayment penalty when you file your taxes. We're getting really short on time. In fact, we're a little over, so I apologize about that. We have listed some tools at the bottom of this. Our website has a tax calendar for just important dates to remember. There's all kinds of really cool calculators on there, retirement, just everything you can think of under the sun. Tools, there's a blog. You can subscribe to receive our newsletter. I think it goes out like a couple times a month. It's not something you're going to be like, oh my God, I'm getting spammed like crazy. But sometimes they're really good articles, and especially for entrepreneurs. So if you're interested in that, please sign up. We have lots of other tax guides if you guys are missing one or would like that. We also have some goodies on the table, so please take those, as well as some business cards. And if you have any questions for us, we'll stick around, or feel free to reach out to us. All the contact information is on the guides and in our cards. Thanks so much.
Thank you.
So if you ladies would be okay with maybe 5 minutes of questions, would that be okay? If anybody does need to leave, though, I know we have a busy schedule, so feel free if you need to leave, but we'll do about 5 minutes of questions, if that's okay. All right.
Yes.
We're talking about funding. Are you talking about DAFs, donor advised funds? For,
yes.
Yeah, you are. Okay. There's controversy. I've heard there's good and bad with that.
Have you?
Yeah.
I'm curious. Share with me, because we have a couple. It's brand new, right?
It's a loophole for those that are on the higher income that can kind of get around it. But that's different from the RMDs, correct?
Yes.
Okay.
Yes.
So there's two different things. Okay.
Yes. Yep. RMDs are usually required minimum distributions. Those are usually associated with like retirement and what you have to take at certain ages. The donor advised fund, which is what we touched on earlier with the charitable contributions and bunching, that's the fund that you can pretty much donate to 1 year and take the whole deduction. They're new, so they're new. And the other thing is there could be limitations as far as when and how you can allocate, and that is something you'd have to discuss with the brokerage firm. I don't really, from what I know, they're intended to be pretty easy. If you want 10 grand a year, great, but I don't know the intricacies generally as far as that goes.
Thank you.
Yeah.
Can you talk to us about the difference in actually buying a vehicle for your business and doing the mileage?
Yes.
My guy is saying just do the mileage.
Yes,
But I
that's a great question, and I had it on my list, so I'm glad you brought it up. So with vehicles, there's basically two different routes you can take. There's one that is actual expenses, and there's one that's standard mileage. Actual expenses means you add up all of your actual expenses on that vehicle, the purchase price that you get to depreciate, so your depreciation, okay? Then there's insurance, there's gas, there's repairs, maintenance, all of everything that's associated with your vehicle.
Like
Parking, sure. Yep, so you take all of your actual expenses, then you determine your business use percentage. How you do that is based on your mileage. So you have to be good about tracking, right? And this is something I wanted to touch on too with all business expenses. Documentation. I know it's tedious. I know it's terrible. But you would hate for those to be disallowed if you ever were to get audited. So track your mileage. It could be as much as taking your speedometer at the beginning of the year, at the end of the year, saying I drove 10,000 miles this year. 80% of it is business use. 8,000 of them were me going back and forth between seeing clients or whatever it might be. So if it's 80%, let's just say for an example, you take 80% times all your actual expenses, that's your deduction. Okay. So if that is lower, maybe, or if you don't have a lot of actual expenses, or the depreciation would be really minimal if you drive a junker car, maybe that's not the best route. On the other hand, you have your standard mileage. And it's always good to calculate both and see which one gets you a better deduction. Standard mileage says however many business miles you drove, so that same 8,000 of the 10, you take that 8,000 by the standard mileage rate, which is now 58 cents per mile. See what they
2020 or 2019?
That is 2019.
Is what, how much?
58 cents.
58 cents.
Yeah, so that's for the tax returns you'll be filing now.
Right.
See which one is higher, and that's the rate you go. So you kind of have to get good records, right? What all your actual expenses were, what your mileage was, and that's how you determine those.
I think one thing you have to be aware of is that I think the standard mileage is usually like the safe way for IRS. and there's certain limitations on if you are on if you are on actual, you can go to standard. But if you decide, oh, I'm gonna go back to the actual, I think there's a limit on that. You may not go back.
That's a good
go back to the actual.
I believe how it is you have to, if you ever want to take the standard deduction way or the standard mileage, you have to do that the first year you buy the vehicle. Then you can flip flop back and forth if you want, whatever's better. But if you don't take standard mileage the first year and you choose actual expenses, you're stuck there. Really weird. Really weird. Either you do actual and you're stuck there, or you do standard mileage and then you can flip flop. So the safe thing, like Sarah's saying, the first year maybe is to do standard mileage because you don't know what future years will look like. And it's by vehicle as well. So if you buy another vehicle, you can do the same test.
Do we know the rate for 2020 yet?
Anybody?
It was just published. It's lower. I don't know what it is though.
57.5.
Yeah.
Yes.
A general question for you. Is anyone using a good app for that right now?
For mileage?
Yeah.
Excel.
It's a cheap little calendar from the dollar store. I leave it in I leave it in my car every time I'm doing this. I just write it in on that date, and you've got a document that's, and it matches my calendar if somebody ever audited. And then every quarter I go through and I figure it out and I give myself a mileage check. It's old school, but you know what? It works, and you got something in your hand that you can put with your file that you hang on to.
I use Smile IQ. It'll give me a printout of the report. It also tracks where I go, and I'm able to mark it as personal or business.
What is it called?
Smile IQ.
A lot of our
And
clients
if
use
you
it.
have Office 365, I believe it's actually included as part of that, although I haven't figured out how.
One other thing, is really quick, if I could touch on this because I missed it, and I'm sure it's applicable to all of you. Travel and meals and entertainment; those are two big ticket items, right? Travel, if it's for business, you can deduct it. Okay, be careful. If you go to a conference in Las Vegas and you stay 3 extra days, a portion of your trip is business and a portion is personal. I hate to break it to you, you can't say the whole thing. Oh, I was there for business, so I'll stay an extra week and I'll deduct it all as a business expense. Same thing. You got to figure out the portion that's business, the portion that's personal. Anything that's business, though, for travel, you do get to deduct 100%. Meals and entertainment is a little different. With the Tax Cuts and Jobs Act, it used to be that meals and entertainment, meaning sporting events, other things you go to with your clients, you can deduct 50% for your tax return. So you take your total, divide it by 2, that's what you get to deduct. Now, the IRS has completely eliminated the deduction for entertainment expenses, which is huge for a lot. I mean, for us, we entertain a lot of clients. We got sweet tickets to some places, right? So some businesses are, there's a fine line between entertainment versus marketing. Maybe if I'm going to a sporting event, but we have a nice big banner in the back, and that could be marketing and promotion. Maybe that's not entertainment. So that gets tricky, but just know, if you're entertaining people, clients of yours, generally you do not get to deduct entertainment, and you need to track those expenses separately. One of my biggest pet peeves for anyone who uses QuickBooks, I'm sure it's a lot of the accounting software still, they have all these pre-set up accounts, right? And one of them is meals and entertainment still. Even though those have different deductibility, I hate that because people just lump it all together, and then our job at the end of the year is to sort out what's entertainment, not deductible, and what's meals. Meals, for the most part, just to keep it very high level, are 50% deductible still, if they're for business use.
And I think one thing on the documentation for the meals, especially the business meals, so it's supposed to be you get the receipts, and in the back of the receipts, you have to write down who you had lunch with, what's the business purpose, basically what we talked about, and of course the receipts probably have date and time, and maybe the business person's name. So that's just documentation, because if you got audited, IRS is looking for those.
Yeah, and that's huge. And once again, you'd hate to miss out on a deduction because you get audited and then you got to pay it all back years later. It's tedious, but just get in a habit. After you have dinner or lunch, write it down and throw it in a file folder. Keep it in the basement for a couple of years. I mean, it's really a best practice, and it's required to take those deductions.
How long do you recommend we keep our files, for individual as well as business?
Typically 7 is what we tell people. 5 is usually pretty safe as well. 7 is kind of
I had
our
somebody
typical.
tell me it's down to 3, that they won't audit you after 3.
That's because, right, the statute of limitation is 3 years.
Yeah.
But I think if you're under, like, report your income over 25%, then they can go over 3 years.
Yeah,
That's my-
yeah. So typically the statute is 3 years. That's fine. In most
Yeah.
cases, you're probably safe.
Yeah. So
We
for
tell
business
people to be
ones,
extra
they gotta
careful.
go for 7.
Yeah.
Not
Any other questions?
All right. Well,
Okay.
big round of applause for Sarah and